There's a lot of momentum that you get behind Fed decisions. When they do 0.75 of a percentage point, it's hard to get off that because if they slow down, then everyone says, oh, they're going to stop. And if they stop, everyone says, oh, they're going to cut rates. The market is always 2 steps ahead of them. So the Fed is kind of stuck in this path of continuing to do what they're doing, or else because they're afraid that the market's going to get ahead of them.
Reactions continue to trail the Fed's decision to raise rates. Raoul Pal, who has always maintained that the Fed should not be raising rates at all, gives us his insight on the likely outcome as the Fed stays its course on increasing rates. One thing that definitely needs to increase is the number of our viewers that are subscribed to the channel. To track the assets and crypto market, subscribe now to follow all the latest from the investment gurus.
Let's go back into the money system now. So what happens now is that wages are never going up again. So everybody keeps saying inflation's coming. Inflation is in the old terms of inflation of demand-driven CPI, never, ever coming back in our lifetimes.
Right.
And in fact, it's provable because you take the births deaths ratio and put it against CPI, it leads by 30 years. Exactly as I said. You hit your peak spending in your 30s, that's inflationary power, and it exactly follows it. And I'll share this chart and you'll be able to see it. But also what happens in 1987, Alan Greenspan did something that we haven't done before, which was as the stock market crashed, he hit the panic button and cut interest rates to stabilize the panic. The unintended consequences of that is it suddenly became a tool in the central banker's box. There was no recession in 1987. Maybe interest rates can stop the business cycle because that's really what we want to do. And if we can stop the business cycle, then we can probably reach our employment mandate. And if we're lucky, we can reach our inflation mandate because demographics mean it's actually pretty hard to generate inflation in that way. Currency debasement, different type of inflation, not measured, right? As we all know.
Raoul Pal takes us back in history to the 1987 stock market's crash. The crash was even steeper than anything we have experienced this year. The Dow Jones had crashed by a jaw-dropping 26% in a single day. How did the Fed respond at the time? Alan Greenspan, the then head of the Federal Reserve, knew the only way to revive the market was to ease the market. This was just a couple of years after the constrictive fiscal measures that Paul Volcker, the former Fed chair, had introduced. Paul Volcker had increased rates to 20%. That's astronomically high compared to the current 4% rate we have now, but the effects are similar. We're seeing a struggling stock market, and all asset markets seem to be pulling against the weight of the rate hikes. Even though the massive quantitative easing QE was going to save the stock market, Greenspan knew it would create future problems. The problem of an economy flushed with too much money. Increasing M2, which is money in circulation. It was what led to the current inflation problems being suffered in 2022. Alan Greenspan would have created the same problem in his time if he had responded aggressively to the situation. Instead, he allowed the market to ease out of the ditch on its own. This is what Raoul Pal thinks the Fed should be doing at this time, letting the market ease out instead of the continued quantitative tightening heralded by the increasing federal rates. Next, he talks about the performance of asset classes such as gold and cryptocurrencies.
So they've got the trick that they know is debasement, hides the reality. So what's interesting is people have started to figure this out. They've started to figure out they're getting screwed. And the figuring out getting screwed drives you to look for answers. The traditional answer was gold. Hasn't done great. It's done okay. It's done its job. But the problem is the millennials can't generate wealth. If gold defends your wealth,
right? There's nothing to defend.
Nothing to defend.
Yeah.
So it becomes incredibly difficult to generate wealth. Bitcoin comes along, it changes the equation. It takes a long time for people to see it, but these things, this adoption takes a while. But people realize, okay, here is a construct, a technological construct that has ubiquitous global scarcity. And therefore, if we all perceive it to have value, then it shall be so. And And so the migration begins. And I think of it as a migration to this parallel financial system that's being built in front of your eyes.
Mhm.
The rise of DeFi was the other huge thing that happened. People haven't got their heads around what this means yet,
Mhm.
but it is gigantic because basically people don't trust financial intermediaries any longer. Again, they want to blame somebody, so blame
Right.
the banks. It wasn't the bank's fault. They just did the rational thing.
Gold not performing to expectation is no longer news, and it seems the precious metal is stuck in this limbo. Gold, which traditionally rallied in risk-off economic situations such as we've seen in 2022, surprisingly refused to be an option for most investors. This could be in part the result of a strong dollar, which has provided a better margin than gold. Gold is down by about 20% from its first quarter high, which puts it in the class of some of the worst performing assets in the past year. Warren Patterson, who's head of commodity strategy at ING, told CNN that investors have lost their appetite for the yellow metal. It should be recalled that gold had reached in March because of fears induced by Russia's invasion of Ukraine. The markets had expected a total collapse if the war escalated to other countries. Subsequently, investors had relaxed on stocking up on gold, which has led to its downward spiral. Raoul Pal points out that the decentralized market is opening a new channel that is disrupting the industry. DeFi was valued at about $11.78 in 2021, and poised to grow much bigger in the not-so-distant future. Some experts believe that DeFi would replace institutional financial services providers in the next 3 to 4 years. Perhaps this is the reason why banks such as JP Morgan are beginning to create their own DeFi. JP Morgan last week had its first DeFi trade on a public blockchain. This is a major indication of institutions adopting the blockchain technology to better their services. This is likely going to user in the use of tokenized assets to financial instruments, and probably see cryptocurrencies gain institutional use.
The conversations I've had with corporate treasurers was that I presented some of the biggest corporate treasurers in America. And I'm like, guys, what do you use your cash for? And they're like, well, we use it for share buybacks, M&A, and cash cushion, and we purchased real estate.
Mhm.
Like, fantastic, great, okay. So your cash, you'll earn what? Maybe they're great treasurers. Maybe they get 3% on their cash. I'm like, great. Look at the price of assets. They're going up at about 15% a year, 20% a year in line with the balance sheet. So next year you can buy less of your shares back, or less of another company, or less of
real estate.
So this is why you need Bitcoin on your balance sheet, because it actually helps offset it, because it's got the two benefits of, it's got that kind of exponentiality, the call option on the future, the network effect, and it's got the other side of the equation, which is it offsets debasement.
Raoul claims Bitcoin is the best hedge for now. Ethereum recently enjoyed a resurgence last week, rising by 7%. Could this be the end of the bearish market? Like this video and subscribe to our channel as we continue to keep a close watch on the market.